Welcome back to Smart Stock Sam, the channel where we cut through the noise, follow the data, and find the trades that actually matter before the crowd even knows they exist. I need you to stop scrolling right now, because what I am about to walk you through is one of those rare, precise moments where everything, the technical signals, the fundamental story, and the smart money positioning all align at exactly the same time. And if you have been watching this channel for any length of time, you already know what that kind of confluence means. It means the move is not just possible, it is already in motion. And for AMC Entertainment, the confirmation has been rolling in one catalyst at a time. Here is the big question I want you to sit with for the next few minutes. What would it take for you to genuinely believe that a stock the entire Wall Street machine labeled a zombie company, a name they buried in bearish research reports and dismissive headlines, is quietly being reconstructed into a recovery story that some of the most sophisticated institutional funds in the country are now betting real capital on? Because that is precisely what is happening right now. Today, we are going to walk through the complete anatomy of this setup, from the oversold technical exhaustion that flashed a clear warning signal on May 18th to the CEO personally walking into the open market and deploying his own hard-earned money, to the institutional whales who have quietly maxed out their positions to the very legal limit. We are going to look at the breakout that already delivered real gains in real time, map the catalysts that are still loading in the weeks ahead, and identify the one critical technical wall that every trader needs to respect before this thing can run further. This is not hindsight analysis wrapped in post-game commentary. This was a live prediction that came true in the market, and the next chapter of this story is still being written. Let us get into it. To understand where we are today, you have to understand exactly where we were just a few days ago. On May 18th, AMC hit what I call a point of technical exhaustion. The relative strength index, the RSI, dropped all the way down to 31.7. For those newer to the channel, the RSI measures the speed and momentum of price movement on a scale from 0 to 100. Anything below 30 is traditionally classified as oversold, meaning the stock has been pushed down so hard and so fast that it is like a rubber band stretched to its absolute breaking point. At 31.7, we were sitting right on that razor's edge. But here is the critical insight that separates serious traders from the crowd. An oversold reading is not just a warning sign to watch passively. When it appears alongside specific fundamental setups and deteriorating short-side liquidity, it becomes a predictive model, it becomes a map. And that map was telling us, with unusual clarity, that AMC was a coiled spring sitting in a very tight box, waiting for one single spark to send it flying upward. I know the skeptics are already thinking it, so let us go directly to the scorecard. The results from the last 72 hours have been extraordinary, and I want to be completely direct with you about that, because accountability is what this channel is built on. In the May 18th analysis, I identified three critical zones. First, the entry zone. I flagged $1.27 to $1.28 as the floor that should hold. The market actually bottomed at $1.24 before immediately gapping higher to close at $1.36. Second, I called for the $1.30 Fibonacci pivot to flip from ceiling to floor. And on May 19th, that base held firmly at $1.36, confirming structural support was locked in. Third, the target objective was a move to $1.45 to fill the post-earnings gap. What actually happened? That level was not just hit, it was demolished. On May 20th, AMC surged to an intraday high of $1.60, a gain of 11.76% in a single trading session. That is not luck. That is the power of reading the map before the crowd even knows a map exists. But while the technical setup provided the roadmap, something else entirely provided the detonator. On May 19th, something happened that the market had not seen from this company in over a year. CEO Adam Aron stepped directly into the open market and purchased 250,000 shares at a weighted average price of $1.38, a total personal capital deployment of $344,350. Now I want you to really sit with what that action signals for a moment. This was formally classified as a pure buy in the SEC Form 4 filing, meaning zero offsetting sales, zero hedging strategies, and zero ambiguity whatsoever. It was a clean, unhedged, direct statement of personal conviction from the one person on this planet who has more material, non-public knowledge about AMC's actual trajectory than anyone else. Think about it this way. Corporate insiders sell shares for countless reasons: tax planning, estate diversification, planned compensation programs, personal liquidity needs. But there is only one reason an executive reaches into their own personal account and buys shares at current market prices. They genuinely and firmly believe the stock is headed higher. This purchase effectively front-ran the upcoming movie catalysts we had been modeling and served as the ignition spark for the short squeeze mechanics that were already building dangerous pressure beneath the surface. And critically, the CEO was not the only smart money quietly loading up. While retail traders were focused on daily price fluctuations and social media sentiment, the institutional whales were making some of the most aggressive positioning moves I have tracked in this name across many months. Consider Pentwater Capital. They currently hold 63.6 million shares, positioning them at 9.99% of total ownership. Why does that specific number carry such enormous significance? Because 10% is the hard regulatory ceiling before a holder is reclassified as a primary insider and faces an entirely different, far more restrictive set of SEC reporting requirements and trading rules. Pentwater has effectively moved to the absolute maximum conviction level they can legally hold without triggering that reclassification. They literally cannot add a single meaningful position without crossing a legal threshold. And then there is Discovery Capital Management, which just increased its existing stake by a staggering 41%, now controlling 8% of the company outright. Ask yourself honestly, would a sophisticated, risk-managed, long-term institutional fund deploy that kind of fresh capital into a name they still believed was simply a survival story with no upside? Absolutely not. They are not positioning for a short-term speculative flip. They are building for a structural re-rating of the entire business model. And the sell-side analyst community is finally beginning to acknowledge what the whales already know. We are watching a genuine, measurable sentiment pivot unfold in real time, a decisive shift from the narrative of survival to the narrative of recovery and potential re-rating. Benchmark just upgraded AMC to a buy rating with a price target of $2.50. Their core thesis centers on the belief that free cash flow break-even is now achievable without requiring ticket volumes to fully recover to pre-pandemic levels. That is a fundamental valuation game changer. Wedbush went even further, reiterating an outperform rating with a $3 price target and pointing to potential EBITDA margins expanding to between 13 and 16% by 2026. Even the more cautious voices, like Roth MKM, adjusted their targets upward to $1.50, acknowledging the stabilizing trend developing inside the business. When multiple analyst firms are raising their price targets to levels that are double or even triple the current trading price, it creates what I call a permission structure for additional institutional capital to flow in. But the real accelerant, the force that turns a strong momentum move into a genuinely explosive short squeeze, is buried in the short interest data. Here is where things get genuinely explosive, and I mean that in the most literal market mechanics sense possible. There are currently 106.2 million shares short, representing approximately 15.32% of the total float. But the single most important metric is not the percentage. It is the days to cover ratio, which currently sits between 4.93 and 5.68 days. That means if short sellers attempt to exit their positions simultaneously, it would take nearly a full trading week of average daily volume just to absorb the exit pressure. And here is the detail I want you to really focus on. In just the last 24 hours, the availability of shares to borrow for new short positions collapsed from 10 million all the way down to 5.1 million. The supply is evaporating in real time. What happens when rising demand from panicked short sellers being forced to cover collides with a rapidly shrinking supply of borrowable shares? You get a violent, self-reinforcing feedback loop that can move a stock 10, 15, 20% in a single session. Every penny the stock moves up forces another short seller to buy back shares at a loss, which pushes the price higher, which forces the next short seller to cover. This is the pressure cooker that powered the May 20th breakout, and when you overlay this onto the actual chart, the anatomy of what happened becomes unmistakably clear. On May 19th, the stock established a tight consolidation base, trading between $1.35 and $1.46, successfully holding the new $1.30 support level we had identified. After market close, the Form 4 filing for the CEO's personal purchase hit the wire and triggered an immediate after-hours surge of 6.18%. Entering May 20th, the momentum became truly unstoppable. The stock opened strong at $1.45 and trended steadily higher all session, ultimately hitting that $1.60 intraday peak. What made this move so structurally significant was not only the magnitude of the gain, it was which specific technical lines were crossed in the process. In a single session, AMC cleared 3 of the most closely tracked technical benchmarks in the market simultaneously. It pushed through the 50-day simple moving average at $1.34, the 100-day simple moving average at $1.37, and the 20-day simple moving average at $1.50. Closing above the 20-day moving average is particularly constructive because it signals a clear shift in short-term momentum from bearish to definitively bullish. When a stock clears 3 historical resistance bands in one decisive move, it does not just bounce, it converts overhead resistance into structural support. Former ceilings become floors, and now the most important question is, what keeps this momentum alive once the initial catalyst excitement fades into the background? The answer is a forward catalyst map that is genuinely loaded with opportunity. On the micro side, May 22nd brings the theatrical release of The Mandalorian and Grogu, and this is not just another movie. This is a franchise-driven, high-margin concession revenue machine tied to one of the most beloved entertainment properties on the planet. Following that, June brings the launch of the Arena One live concert series, using a high-margin, low-overhead event format that Wall Street has been waiting to see AMC execute successfully. July, then, brings a Fathom release to fill any calendar gaps and maintain throughput. On the macro side, we must stay honest. Treasury yields are still hovering around 4.65%, applying consistent pressure to the balance sheets of highly leveraged companies like AMC. The Federal Reserve minutes will be monitored carefully for any signal on the interest rate path. This creates a genuine and meaningful tug-of-war between the bullish micro setup and the challenging macro headwind, which is exactly why having a structured and disciplined trade plan matters more right now than it has in many months. Here is the technical map you need to navigate the week ahead. Current closing price is $1.52. Immediately below, the crucial psychological base sits at $1.50, aligned directly with the 20-day moving average. Drop below that, and $1.40 becomes the lower structural support. These are your floors. If we lose $1.40 on a closing basis, the bullish thesis requires serious reassessment. To the upside, $1.60 is the immediate first ceiling, the recent intraday high that needs decisive clearing. Beyond that, $1.80 becomes the next meaningful target. But the level that everyone in this market is genuinely watching, what I am calling the final boss of this setup, is $2 even. That is the 200-day simple moving average, and it represents a wall of accumulated historical resistance. Getting cleanly through $2 is going to require more than a single CEO purchase. It is going to require a coordinated, sustained, short-covering event of real scale. The options market is already pricing in exactly that kind of volatility ahead. At the May 22nd expiry, the $1.50 strike shows over 21,000 contracts of call open interest compared to only 2,000 put contracts. The market is placing a very heavy bet that $1.50 holds as the new launching pad. Meanwhile, there is a significant call wall building at $2 with nearly 16,000 contracts, which acts as gravitational ceiling resistance as market makers manage their hedging books when price approaches that level. The options flow is clearly leaning bullish, but that $2 wall remains a serious structural obstacle that must be respected. Before I bring you the final verdict, something important must be said directly. Nothing on this channel, including this video, constitutes financial advice, investment advice, or a recommendation to buy or sell any security. AMC Entertainment is a highly speculative stock carrying significant debt load and operational risk. Implied volatility at approximately 130% means the market is pricing in violent price movement in either direction. You could lose a substantial portion or all of your invested capital. This content is produced strictly for educational and informational purposes. Always conduct your own thorough due diligence, and if you require personalized financial guidance, please consult a licensed financial advisor before making any investment decisions. Never invest capital you cannot afford to lose entirely. Now, the final verdict. The rubber band has snapped back. If AMC can maintain its structural base above $1.50 through the Mandalorian release on May 22nd, the path toward those $2 to $2.50 analyst price targets remains both technically and fundamentally viable. The tailwinds are real and measurable. Institutional repositioning at maximum legal conviction levels, extreme short interest metrics creating a pressure cooker environment, a CEO who put his own capital on the line as a direct confidence signal, and a forward catalyst calendar that has genuine capacity to sustain momentum through June. But discipline is the single most important variable in this entire equation. Implied volatility guarantees violent intraday swings in both directions. Position sizing is not optional. It is your survival mechanism. I will be watching that $1.50 level extremely closely, and I will bring you the update the moment anything material shifts. Here's the question I want you to answer down in the comments. Do you believe AMC can break through and close convincingly above the $2 wall before the end of June? Or is the macro environment simply too heavy for it to sustain the momentum that far? Drop your honest take below. I genuinely read every single comment on this channel. If this breakdown helped you see the setup more clearly and gave you a more structured way to think about this trade, please hit the like button right now. It takes 2 seconds and it helps this analysis reach more people who are searching for exactly this kind of data-driven work. If you are not already subscribed, hit that subscribe button and turn on notifications so you never miss an update when it matters most. And if you truly want to support what we are building here at Smart Stock Sam, you can send a super thanks directly through the YouTube support feature. Every single one of those contributions means the world to this channel and keeps us producing content at this level. Thank you sincerely for watching. Stay disciplined, stay data-driven, and I will see you in the next update.